Hey, Rustam.
Hi.
Hi, everybody.
Hello. Nice to meet you.
So we're only missing Will. Okay, I guess we're all here. So we'll just give it a couple minutes and start on time. And yeah, and we'll be following the order that's on the agenda, if that's okay with everyone.
And it's 20 minutes with 10 for questions, or 25 and 5, or?
Yeah, we can do, yeah, exactly. So there's like 30 minutes for each paper. So I'll kind of like let the presenters
Perfect.
allocate.
Perfect.
Shift the distribution. Yeah, let's target, I guess, 25-5, but you get a little buffer.
Also, should we save comments until the end, or can we interrupt? Or
my preference is interrupting. Yeah, so you have 30 minutes. But also because we have limited time, if someone is being extremely annoying, feel free to tell them shut up, because it's your 30 minutes.
So the usual stuff, basically.
Exactly. Yeah. I like to keep it like relatively informal, but there's limited time, so a fine balance we have to. Okay, I guess we can start because it's 11, and we're very happy to have 4 very interesting papers here in this session that's sponsored by the Federal Reserve Bank of St. Louis, Banking Imperfect Competition, and the Macroeconomy. So we'll just follow the order in the agenda. So we'll start with Kyle Dempsey from Ohio State, then we'll go to Will Diamond from Wharton, Rustam Jamilov from LBS, and then Pierre Mabille from INSEAD. Yeah, so each paper we'll allocate 30 minutes for each paper, ideally 25 plus 5, but yeah, feel free to manage that however you like it. So I'm going to ask Kyle to start sharing his screen.
Okay.
And I'll be keeping track of time.
Okay, great. And everyone can see and all that?
Yep, feel free to go ahead.
Okay, great. Well, thanks for having me. So this is joint work with our distinguished host, Miguel Faria-e-Castro. So this is called the Quantitative Theory of Relationship Lending. And so the starting point for this paper is really recognizing that relationships are an important part of credit markets, but their macroeconomic consequences have historically been understudied. And so we're trying to focus in this paper on a particular facet of the role of relationships in macro finance, which is the propagation of shocks in the financial sector. Okay, so by way of motivation, and there's a lot more to unpack here potentially, but the standard financial accelerator type mechanism, so think Bernanke, Gertler, Gilchrist, or Kiyotaki, Moore, implies counterfactual responses typically in settings with financial intermediaries, right? The idea here is that banks can recapitalize, and therefore the fundamental shock dissipates too fast, right? This is true, importantly, for what we're going to set up here. This is true in settings that have perfect competition, and this is also true in settings where you have a lot of monopoly power, right? So we're going to set up a particular notion of competition in this paper, okay? So as a way of sort of dampening that sort of fast recapitalization mechanism, this paper is going to look at a mechanism by which we close this through relationship lending, okay? In this setting, what's going to be key is that banks are going to have excess profits, right? They have some sort of at least temporarily captive customer base, right? But they can't cash in on those excess profits all at once, right? So it's going to give rise to a very particular nature of competition, okay? The building blocks that give us this setup here is going to be an environment where we have heterogeneous banks subject to financial frictions and this imperfectly competitive setup, right? What we're going to model using what we'll call customer capital, sort of following Guryev and Rodenko and some other literature there. We can also think of them as habits. Borrowers have habits from borrowing at each banks. And there's going to be adjustment costs, right? It's going to be costly for me to sort of shift my portfolio of lending decisions in the aggregate away from certain banks, okay? So as banks are hit with shocks, that's going to add a layer of adjustment that's going to govern dynamics in this economy, okay? Quantitatively, what we're going to find in this paper is that this mechanism really reshapes sort of the aggregate recovery from a financial shock. And in particular, it's going to dampen this sort of top line motivating feature of many models within this literature that we're sort of interested in. In particular, banks who have access to these sort of excess profits that they can use in principle to recapitalize will optimally choose not to do so all at once, right? That's going to mute the impact of a financial shock on the real economy on impact, but it is going to make the recovery more sluggish. It's going to add some persistence to sort of a transitory fundamental shock inside of the banking sector. Okay, so that's going to be the main punchline. Okay. So let's just go over sort of more concretely what we do and what we find. So I'm going to organize this talk into basically two parts. One's going to focus on our model, and the second's going to focus on our quantitative results and some empirical results. So in our model, relationships affect equilibrium in two primary ways, right? First is going to be on the demand side, right? Rather than just there's a single aggregate price that the borrowers in this world take as given, there's going to be a distribution of prices and sort of banking traits that are relevant to the borrower, okay? What's going to be really nice in this framework is that things are going to boil down pretty neatly into three primary moments of this distribution, right? So on the demand side, of course, the high level of interest rate spreads is going to be costly, right? That's going to make borrowing more expensive. There's also going to be some variance in equilibrium in terms of interest rate spread, some dispersion. That's good for borrowers, all else equal, because it allows them to substitute, right? As long as there's some variance, I can always go down the cost distribution for my financing. But in the presence of these habits, or this customer capital, relationship capital, I'll use all of these terms interchangeably, there's going to be correlation between pricing and these habits, right? And if high spreads tend to be concentrated at banks in which I have a low relationship intensity, that can be problematic, okay? Because then I can't substitute as readily into those banks. And so we're going to capture this through those moments. Then on the supply side, banks are going to internalize how these habits and how this customer capital is formed over time, right? So you can think of that sort of in two ways. On the one hand, a bank that's starting out has to build up this customer base. That's going to have certain implications for how they choose to price loans. The other one that's sort of more germane to our initial motivation here is that when faced with a shock to net worth, right, it's going to change the nature of how banks want to respond to that shock, okay? Like I said, quantitatively, what we find in terms of simulating a negative aggregate shock to bank net worth, so sort of a pure financial shock, right, that in principle has nothing directly to do with the lending sector, right? We're going to show that in the aggregate, this is really going to slow the recovery of net worth. It's going to lead to sort of a more persistent drop in lending than a purely competitive case, okay? Lastly, what we're going to do, since our model has these implications for sort of aggregate recoveries, we're going to try and use data to validate our mechanism at the micro level, right? So what we're going to do along this front is construct empirical measures of customer capital, and we're going to look what happened to a cross-section of banks around the global financial crisis, right? So we're going to sort of have this event study type design there, where we're going to document that banks who experienced large drops in market value around the financial crisis, so from before 2008 to right after 2008, they experienced also large drops in our measure of this customer capital object, okay? That's going to be the first point. The second point is that banks who did experience these large initial drops in customer capital subsequently experienced faster recoveries in market value. Same goes true if we hold this for net worth as well, right? So this speaks to customer capital, this relationship object, being sort of an expendable asset in times of crisis that banks at the individual level are going to optimize and decide how to expend. Okay, and that's going to be true both in our model and in the data. Okay. Just briefly, in terms of time, let me just go over the literature briefly. We view ourselves as combining insights from three main branches. First is sort of your standard financial frictions, financial accelerator type literature, like I mentioned before. Second is going to be this customer capital or deep habits literature. Gorio and Rudenko, Ravin, Uribe Schmidt-Grohe. These are all important sort of building blocks for our framework. And then lastly, on the bank side, we're going to have a lot to borrow from sort of classic incomplete markets, heterogeneous agent style setups. Okay. Putting all of these things together the way we do, we're able to deliver a tractable quantitative framework where we can analyze how lending relationships shape these aggregate credit outcomes. Okay, there's an empirical literature on this. Going back to a lot of empirical finance papers in the mid 90s, some more recent papers. There's sort of less equilibrium macro work on this, and so that's where an important paper there is Yasser Boulam's work, but we're trying to sort of flesh that out a little bit more. Okay, so let's dive in. So I'm going to start, the middle of this talk here, I'll devote to the model, and then I'll get into our quantitative results. So I'm going to start with the borrowers, then move to the banks, then move to our equilibrium concept. So we're going to try and collapse everything about the borrowers in this model into one slide here. And the key thing to recognize in this model is that there's going to be a two-part loan demand system in equilibrium, right? We can think of there as being a representative borrower. They operate some decreasing returns to scale technology subject to a working capital constraint, but critically, they're able to source their financing from multiple banks, but they're subject to adjustment costs. So this little stylized, pseudo equation here, we can think of as defining the nature of relationships in this economy, right? There's one product here, it's a loan, right? So loans, all else equal, are the same, right? But there's multiple sources, right? I can get these from different banks. I have a different sort of degree of relationships or a relationship intensity or a habit at each of these banks. And then it's costly, conditional on those habits, for me to adjust my portfolio in response to changes in pricing. Okay, so a world I want you to think about here is there's a set of banks who are being hit with idiosyncratic shocks, responding to that by changing their loan prices. And there's a borrower who's taking into account the loan prices I see and my relationship with these banks when making my individual and aggregate lending decisions. Okay. So let's start at the bank level. Basically, this bank level demand system is going to specify the bank's share of aggregate lending or aggregate borrowing, right, as a function of the habits and the prices they charge, right? So I've tried to sort of match, by color here, the different components of this demand equation to our relationship construct here, right? So first key object here is going to be that the state variable that's relevant to the borrower in this world is going to be this joint distribution of prices and habits, okay? That's this mu of Q and S object, okay? Q is going to be the loan price. S is going to be the level of customer capital or the habit at that bank, okay? The next key object comes from this costly adjustment component. And here's this parameter phi. The way we model this is that there's a quadratic cost of adjustment in terms of loan shares relative to customer capital shares, right? So it's costly for me to get a greater share of my total lending from a bank at whom I have a relatively brief or relatively low relationship intensity, okay? So what's important here is that a high level of customer capital is going to shift up the level of loan demand, but then there's a standard mechanism by which if I charge a higher interest rate spread, so 1 over Q is going to be that bank's interest rate, capital R is going to be the equilibrium average interest rate. If I charge a high spread over that, I'm eating into my loan demand. In the aggregate, what's going to come out of this setting, and we can sort of, we don't need to go into too much detail on the loan demand equation, this L prime equation. What's important is that we replace the standard object, which is the average interest rate, or a common interest rate charged by all banks. In this world with equilibrium price dispersion, we get this effective interest rate, which depends on 3 things. The first is the average interest rate. So this is the typical object. Let's just sum over all banks. What's the average cost of credit? This is sort of a level effect. The second term here reflects who's charging what rates, right? I care about the covariance between spreads and customer capital. If this term is high, that drives up my cost of borrowing in the aggregate, okay? Because it's costly for me to then borrow from who I want to borrow from. The last term here is this pure dispersion term, right? In the presence of a given level and covariance of interest rates, all else equal, interest rate dispersion is good for me because I can borrow from someone cheaper. Okay, so these 3 components now are going to combine to form this new effective interest rate, which is really what's relevant for aggregate demand. Okay, so now
quick question here. So quick question here. So usually with relationships, there's large numbers of state variables. This is tractable because this covariance and variance summarizes everything you need to know about the distribution?
Exactly. It's a pure sufficient statistic. Basically these, L, S, and R tilde, which we see on the all in different points of the slide, are everything that you need to summarize about this. Yeah. Okay. So let me dive now into the banks side of this. Okay. So I'm going to try and go quickly, just lay out all of the facets of this problem and try and highlight the 2 key pieces of this analysis, which are the financial friction, sort of the standard pieces, and our new modeling of this competitive structure. Okay, so the bank problem in some sense is going to be fairly simple. There's just 2 states. I have a net worth and I have a level of customer capital, right? I need to choose my loan price, my loan quantity, my external financing, think of that as deposits, right? And I need to choose how much dividends to issue or dividends to pay out or equity to issue, right? And I'm going to be subject to a sequence of constraints, right? The first 2 constraints in black here are going to be standard budgetary and net worth dynamic equations, right? I have to finance my loans out of my net worth deposits. In terms of dynamics, I'm going to have some return on loans, which is going to face some idiosyncratic shocks, and I'm going to have to pay back my deposits. Okay, I'm going to be subject to a leverage constraint or a capital requirement here that's just going to put a sort of ceiling on my external financing as a function of my total lending. And then the really sort of novel parts of this framework are going to be these bottom 2 slides, the bottom 2 equations. The second to last one is the bank-specific demand function. That comes from the bank-specific demand curve on the last slide. Okay, banks internalize that when they price, that has an implication for how many loans they'll actually be financing. The second, and this is key for our analysis, is that banks internalize the habit formation of borrowers. Right? So they know that if I lend a lot today, right, then they're going to have a stronger relationship with me going forward. If I lend not a lot today, they're going to have a weaker relationship with me going forward. That has implications for both the level of demand at my bank and the elasticity of demand for me. Okay, so this is the key part of our setup here. What does that deliver? And in particular, what do these last two pieces of our model deliver? They deliver this sort of lifetime Euler equation for loan pricing. So there's a lot more equations than I would typically like to do on a short talk here, but let me try and unpack this one. The left-hand side is lifetime net profits of the bank. The right-hand side is going to be what I'll call excess return. Okay, so let's start on the left side. The lifetime net profits are going to combine two pieces here. There's a static component that's captured by this pi t object. That has three pieces. There's the return on loans. There's a shadow value associated with easing my financing constraint or my capital requirement. And then there's a funding cost, right? Every loan I make today is a dividend that I don't issue today. Okay, so that's going to be true within any given period. And then dynamically, there's this additional term, right? Because my pricing decision today affects the demand curve that I face tomorrow, right? So future periods are going to be linked by these customer capital dynamics, right? And so what I want to highlight here is that in a world where there's no customer capital, right? Or even in a world where there's permanent customer capital, right? So that rho would be equal to 1, that persistence, this term goes away, right? There's no dynamic linkages, right? So we can nest those cases pretty easily in our setup. Okay, now let's go on the right-hand side. We can think of this, the sort of rightmost term on the right-hand side as the excess return sort of the return per unit of loan, right? But that's going to be scaled up in this type of setting by the inverse elasticity of loan demand, okay? Again, in the setting where we have no customer capital, this is going to boil down to a perfectly competitive model. This excess return is going to go to 0, right? But in a world with customer capital, that gives each bank some degree of market power. That's going to give banks some excess return that they can tap into in the face of shocks through time. Okay, and that's the key insight of this framework. Okay. We're going to define equilibrium in 2 steps, just to say this quickly. You know, going back to sort of Will's question from before, you know, we do boil down this sort of, in general, large state variable, which is the joint distribution of prices and habits, into a couple of key moments, but that affects how we have to solve this. First, we have to sort of let banks take key demand parameters as given and solve for a banking industry equilibrium. That's going to be sort of our incomplete markets block of this model. Once we have that, we then have to ensure that this loan market is actually in equilibrium, right? Because each distribution of banks, right, implied in this banking industry equilibrium is going to imply different covariance terms, variance terms, level terms for interest rates. So there's going to be sort of an outer loop that involves making these things all consistent. Okay? Okay. So that's all I wanted to present in terms of the model. Just a high-level overview. I'm going to take my last bit of time here and dive into the quantitative stuff. Okay, so first I'm going to look at results in the cross-section, thinking about how the role of relationships shapes the banking industry equilibrium here. Then we're going to look at dynamics, thinking about how this affects the response to an aggregate shock. And then we're going to try and see if we can find evidence and support this mechanism in the microdata. So here I'm just comparing 2 versions of our model in the steady state, and I'm just looking at some cross-sectional moments. Okay, so in the left column, we have our baseline model. That's the one I've laid out. The right column, we have a competitive case. Again, think of that as the limit as that adjustment cost parameter goes to 0. In that world, there's really no notion of customer capital. The bank problem simplifies, and there's no sort of market power at the individual bank level. Okay. Now we've set these 2 economies up so that they deliver the same aggregate loan volume, right? A couple things I want to point out. What does that mean in terms of interest rates? Well, the average interest rate sort of summing across banks in our baseline model has to be lower in order to get the same level of loan volume, right? Because it's not just that level that matters anymore, right? In general, there's sort of a positive covariance term where banks with higher customer capital are charging higher spreads. That makes borrowing costly on average, right? So we see this discrepancy in these pricing moments, right? There's pricing dispersion, there's more dispersion in loan volume in our baseline model, right? What I want to stress here is that you also see different dynamics around net worth here, right? And in particular, the banks in this model, in this baseline model, since it's sort of costly to build up customer capital, right? And since banks face these financial frictions, there is some incentive here to maintain an additional buffer of net worth away from these constraints in order to cash in on this customer capital that you've built up over time. And so you see actually about a 10% higher level of bank net worth on average here, right? So it's sort of a buffer stock type motive, okay? The other thing I want to highlight here, the last thing on this slide, is that you see a pretty strong correlation between customer capital and net worth. That further supports this mechanism, right? Banks are sort of growing by lending over time. And so as they build up this net worth, they become more profitable, they have more customer capital. Okay.
I have a quick question. So do you reverse engineer the baseline such that the total loan volume is exactly equal to competitive, or is it just by accident?
We calibrate it by adjusting these relationship parameters in order to deliver that same, like there's the persistence, the adjustment cost parameter that's going to deliver this, we can make it such that they match.
Because as soon as you depart from perfect competition, you must have the case that quantities are lower than in the perfect competition counterfactual. So you do get that. That your model does deliver a drop in quantities.
Yeah, so you would get a drop in relative to the purely competitive case just because the level of spreads is higher. Yeah, but there is this sort of other force in this model that brings down the level of spread somewhat. But again, there's this subtlety where you care about not only the level, but these also higher order moments. But that's an over answer. Your intuition's correct.
Yeah, that was a bit, that's the first thing that comes to mind when you talk about perfect versus imperfect competition. And second, so your correlation between customer capital and net worth, is it in the cross-section, or is it for the time series? Because
this is a cross-sectional moment.
But then can I interpret it by saying that relationship-based lending intensity increases with the size of the bank, which would be the opposite in the data? Or how is it?
So I think it's a different measurement of intensity that you have in mind there. I think in the interest of time, I might hold off on that question, but we should talk more about that one after. But I think there's a subtle difference there that we should get into. Okay, let me move on to share our dynamic results. I'm running out of time a little bit here. Okay, so here's sort of our big picture quantitative results. So what we're doing here is we're simulating an aggregate shock to bank net worth, okay? Blue line is going to be our baseline model. Think the analogy of the left column on the last slide. Orange line is our competitive case, right column on the last slide. All we're doing is we're taking our steady state distribution of banks, knocking off 10% of their net worth, okay? So what we see across these two economies, first and foremost in our top left panel, is that indeed we sort of do get proof of concept on this first motivating fact here. The net worth recovery is sort of, you see a more persistent drop in net worth coming out of our baseline model than the competitive case, okay? Why does that happen, right? Well, there is sort of the competitive forces in some sense cut against these banks on impact of the shock. And what you see is that the level of interest rates tends to go up less because banks don't want to perfectly sort of cash in on or erode this customer capital just because they're in distress right now. So they raise interest rates less, cut lending less on impact. But then, of course, that saddles them with sort of less net worth going into the future. And so you see total lending sort of stays below for a couple of periods relative to the competitive case, and interest rates stay elevated for a couple of periods relative to the competitive case as well. Okay, last couple of minutes here, let me just wrap up with sort of how we're thinking about validating this mechanism in the data. So the first thing to do is, of course, to find a measure of customer capital in the data, right? We can go into much more detail here. Fundamental issue, we have this object S that is clearly defined in our model. We do not have that object in the data as clearly. So we're looking at a couple of ways of handling this. Group one we'll call proxy measures. I'm going to show results on that today. We can think of sort of a Tobin's Q on our loan portfolio. That's going to be related to this fair value of loans from Atkinson et al. We can think of a learner index or a banking markup type measure related to the Jimenez et al. Work. We could also think about doing something more detailed and diving into sort of loan level rather than bank level data and try and estimate demand relationships. We're not, we're sort of working on that still. We're going to just show the proxies today, right? But what we're going to do now is look at the dynamics at the bank level of our proxy measures in the model or in the data and this S object in our model around the financial crisis. Okay. So the first thing I want to highlight is that what we find is that banks who had large changes in market value tended to also have large changes in customer capital, right? That's true both in the model and in the data, regardless of our proxy measure, right? So this is our interpretation where customer capital is sort of expended, right? I experience these drops in market value, and then my measured customer capital goes down, right? So maybe it's a dampening. So it's a way to sort of dampen the impact of the fundamental shock that happened in the financial crisis. Okay. Secondly, we can ask, well, then what happens after that? Much of our modeling work is devoted to thinking about recoveries. Okay. Here we estimate that banks that had large drops in customer capital on impact of the shock actually had large recoveries in market value thereafter. Okay, that change in, since they change in market value. That's a pretty bad typo. But and that comes through with these negative coefficients. We see evidence for that. Of course, the scaling here is difficult to have an apples to apples comparison, but we do see sort of negative coefficients across the board. So these drops in customer capital implied accelerated recoveries. Okay, I see I'm like right on time here, so let me wrap up. Okay. So we presented a model with imperfect competition arising through customer capital or habits which have persistence that's internalized by banks. And these banks are also facing sort of a standard suite of financial frictions, right? The key thing out of the customer capital block, today's pricing decisions affect tomorrow's loan demand. Key thing of the frictions block means that banks need to expend something to try to smooth out these shocks, right? Because their net worth is a key state variable for them, okay? That delivers this more subtle relationship between prices and aggregate demand, those three moments I talked about. In the cross section, banks want to maintain customer capital. That gives a precautionary motive. Dynamically, it makes recoveries more sluggish, and we find evidence of this mechanism in the bank level at the data, at the bank level in the data. Okay, let me wrap up there. Hand it back over to Miguel.
All right, right on time. Yeah, so we've done the 30 minutes, so let's just like keep going, and let's move now to Will. Sharing the screen. Can you make it full screen?
Yes. 1 second.
It's
Full screen. Can you hear me?
yes, we can. Okay.
Great. And the
great.
screen looks okay?
Yeah, perfect.
Great. Thank you so much for including the paper on the program and for your attention listening. This is joint work with Zhengyang Jiang and Yiming Ma. I believe Yiming is in the audience. Hopefully, maybe she can help me answer questions. And we're studying the reserve supply channel of unconventional monetary policy. So QE has been one of the main responses of central banks to recessions in recent years. Just in the US, the large 2008 and 2020 crises both were responded to with conventional monetary policy cutting interest rates, but once rates got to zero, quantitative easing was the main tool for additional stimulus. Beyond that, other central banks have done similar things. And there's been a lot of work studying the effect of the assets purchased in quantitative easing. Broadly speaking, the idea being that if, say, treasury bonds are purchased, the prices of treasury bonds might be affected. But there's been less emphasis on another key feature of quantitative easing, which is the way that the Federal Reserve pays for these bonds or mortgage-backed securities or whatever they happen to buy. Whatever they're buying, they're always paying by creating bank reserves. So they are swapping some kind of long-dated asset for an overnight asset, effectively, that has to live within the banking system. Only banks have reserve accounts at the central bank. This is effectively like a special bank account only for certain connected banks, which can often pay a higher interest rate than is available to other investors. So what QE does that as effect is puts large quantities of these liquid assets into the banking system that must live there. And we want to understand what is the effect of this injection of trillions of dollars of bank reserves into the banking system on bank borrowing, bank lending, all the classic questions of what a bank would be doing. And the main answer we're going to find is that every dollar of reserves created by quantitative easing crowds out 13 cents of bank lending, primarily to firms. So we study a model with multiple dimensions of choices banks can make, but empirically what we find is that lending to firms, particularly syndicated loans, is crowded out by the issuance of these reserves that have to be held on bank balance sheets. We answer this question with a structural model, which is effectively supply and demand for bank lending, bank deposits, mortgages, all the classic things banks do, integrated into a joint framework. And one of the key things we're trying to do in this paper is identify the model entirely off the cross section. So we don't want to act like QE itself is some kind of an exogenous shock. We're going to try to rely on variation we do think is exogenous, or at least more so, to identify a model in which we can then simulate a counterfactual of injecting reserves into the banking system. And with this model, we reach the answer that we crowd out this lending to firms, 13 cents per dollar of reserves injected. So in principle, if you look at the various banking theories that exist, you might say that this would either increase or decrease lending quantities. If you think that reserves are a scarce liquid asset, that banks are really constrained by this liquidity mismatch between illiquid loans on the asset side, liquid deposits on the liability side, increasing the supply of liquid assets they can hold might allow them to ramp up their lending. This is the classic money multiplier logic. This is built into reserve requirement type ideas. Kashup and Stein is one paper along this line. But if you think that reserves are not quite so special, if you think that they're similar to the other assets banks hold, the benchmark there is if you have constraints at costlessly expanding your balance sheet, holding more of one asset will naturally make you hold less of others. And in this idea, where we think of reserves and loans being not so terribly different from each other, holding more reserves would naturally crowd out banks' desire to hold loans and therefore might reduce their lending to the private sector. Empirically, this is what we find, but because the theory could go either way, naturally, this is an empirical paper rather than an a priori result. So here is some very low-tech evidence consistent with our findings. This is just raw time series plots, which is the fraction of banks' assets that we're calling illiquid. This is everything except reserves, treasury bonds, and agency mortgage-backed securities. This crashes over time as the supply of reserves increases, which is driven entirely by QE. So every time there's an asset purchase with QE, reserves are used to pay for that purchase. So this is sort of a measure of how much has been purchased, the aggregate size of the QE program. It grew after 2008, peaked in 2015, some tightening of the balance sheet, and then in the COVID crisis, another big spike as there was another round of stimulus. Now, this time series trend is not causal necessarily because QE is a response to severe economic crises. We might just be picking up on what happens to bank lending in crises, not what happens when there is an intervention by the market. Similarly, we don't want to say that COVID vaccines cause people to die of COVID, but in a correlative sense, there are more COVID vaccines given out when there are a lot of COVID deaths, if you look at the broad time series. So same kind of issue. We want causal effect when the aggregate is not so clean. And that motivates this structural approach we're taking using microdata. And we really need to answer two key questions. One is how elastic is the demand for bank loans and deposits? So if there's a change in the cost of providing loans and deposits, how much does that pass through into equilibrium quantities? And then the second thing on the supply side is how much is injecting reserves into the banking system change the cost of capital for banks to provide loans, to provide deposits, and so on. Once we've estimated these two key pieces, that identifies the question that we're interested in, this counterfactual of the reserve injection. This is the supply and demand side of answering that. All right, so our main finding is this reserve supply channel of QE, where every dollar of reserves crowds out 13 cents of lending. Deposit and mortgage quantities are effectively unchanged. And the main reason why we find this is that bank loan demand is considerably more rate elastic, at least at the aggregate level that we're interested in, than deposit demand and mortgage demand. So the interest rates change here by comparable amounts, but the quantity changes are almost entirely in the syndicated loan data that we look at. So we write a counterfactual where we pick the size to match that there was about a 15 basis point difference between the yield on reserves and discount rates for similar investments, the Fed funds rate available to non-bank investors. This takes a 4.23 trillion reserve injection in our benchmark counterfactual, which is similar to the size of the Fed's actual balance sheet, how many reserves are truly injected. It's a little bigger, but similar. That 15 basis point passes through to about a third of that, a little bit more to deposit and loan rates. And that leads to this relatively large reduction of about 550 billion of loans to firms reducing because the demand elasticity there is so high. And the key mechanism here is banks have to hold reserves. That's why we get this spread between the reserve rate and discount rates for investments available to everybody else. And that there's this cost of adjusting bank balance sheets. They just can't costlessly borrow and lend and pass it all through. And there's reasons you might think that has something to do with the regulatory environment, which I might get into. All right, so this is related to a lot of papers that have studied the asset side of QE, the effect of the assets purchased, what that does to the term structure of interest rates and so on. This paper also relates to the literature in banking theory on asset liability synergies on bank balance sheets, which is a crucial thing for our transmission mechanism. What we're interested in is how does a bank's holding of liquid reserves affect its cost of providing loans and deposits, which is a connection between an asset that the bank holds and, for deposits at least, a liability that they issue. You know, banks only exist because you want to bundle lending and deposit taking jointly. And one of our estimates is the first to quantify how much the quantities on one side of the balance sheet affect the costs on the other. And this also relates to a large structural literature where our methodological contribution is we rely entirely on this cross-sectional microdata that lets us use what we think are relatively credible instruments where the same bank is active in different regions of the country instead of bank level variation where these instruments wouldn't be possible. All right, so here's the model. It exists on one slide, but it's a slide I should go kind of slowly on. There's going to be a bunch of banks competing with each other, which are each going to face residual demand curves in the various markets they're active in. So the quantity of loans I get to make depends on my interest rate. If I'm bank I, that's RLI, but it also depends on the vector minus I of everybody else's interest rates as well. So I have some market power. It's not a perfectly competitive market, but also there's competition as well because other people can steal business from me too. So there's going to be these residual demand curves each bank takes, and then banks are paying what we're going to call a liquidity cost, which depends upon the composition of their entire balance sheet. This is where we're quantifying this notion of asset liability synergies that, for example, securities S, that includes reserves, that's our liquid assets. The quantity held there might affect the marginal cost of providing a deposit or providing a loan, but flexibly, we need to estimate this entire function of how each balance sheet quantity affects the cost of providing everything else. And banks are going to maximize their profits, which is going to be a spread between the interest rate they either pay or charge, depending whether it's lending or deposit taking, over a competitive rate times the quantity. And then in addition to that, we're going to subtract off this liquidity cost. So let's say they have a 20 basis point markup on loans above marginal cost times, a certain quantity. You multiply that together and get profits. Banks are going to maximize their one period profit by picking all their interest rates. And that's going to give us first order conditions of marginal revenue equals marginal cost. That's the standard thing in either monopolistic competition or pure monopoly. Reserves are going to trade at a competitive market. So there, the reserve interest rate, which is common across banks, that's set by the Fed, is going to be set equal to marginal cost. All right, so here is the model in a picture. So marginal cost equals marginal revenue is the standard first order condition when you have imperfect competition. The intersection of the marginal costs and revenue curves determines the equilibrium interest rate. That's what's chosen to maximize profits. Then once you have that, you plug that into the demand curve and you get the equilibrium quantity. So this is how prices and quantities are set for the lending market. Let's see what happens in our counterfactual. Let's shock this with what we think the reserve injection is doing. This is what we find empirically, that more reserves on bank balance sheets raises their cost of providing loans. I'll show you my estimates when we actually get to them. And that is going to shift the marginal cost curve and drag it across the marginal revenue curve to a new equilibrium interest rate. That gets plugged back into the demand curve to get a new equilibrium quantity. So this tells us what we need to know to figure out how our counterfactual works. How big is the shift in the marginal cost curve? And what is the slope of the marginal revenue and demand curves? If we knew that, then this one picture simplification of the model, we know how the counterfactual works. And that tells us really what we have to estimate. These residual demand curves, once you allow the banks to compete with each other, that's a demand system rather than a demand curve. We're going to estimate that industrial organization style. And there's this broad intuition that if you want to estimate a demand curve, you need an exogenous shock to supply. I'll show you the one we use for that. And then to estimate the supply side of the model, to trace out the marginal cost curves, you need shocks to demand. And we're going to have multiple of those as well. The reason why we need multiple is because the bank is a multi-product firm in some sense. It provides deposits and loans together, not separately. So really the marginal cost curve isn't just one dimensional. It depends upon the entire composition of the bank's balance sheet. That identification question is one of the key difficulties in this paper. All right, so the first step is to estimate the demand side. We want to exogenously shock the supply of deposits and loans and so on. We're going to have instruments that do that across regions of the country. And we're going to therefore use microdata at the bank branch level. So we have FDIC for bank deposit quantities, rate watch for interest rates, HMDA for mortgage quantities, rate watch for mortgage rates. And then for lending to firms, we're going to use DealScan, which is a firm bank match data set. And we're going to use that for state level markets definition there. So that's still going to give us geographic variation based on where the borrower's location is, their headquarters. And then we're going to use the call reports as a bank level skeleton to put this all together. All right, so to identify the demand side, we need an exogenous shock to supply. We needed to change the interest rate offered to borrowers or depositors, depending upon which market we're looking at, in a way that does not affect the desirability of the loan or the deposit taken. So we can't have it be ATM machines are dropped as well as an interest rate change, because that'll change how desirable the deposit is as well. The shock we're going to use follows a paper by Cordes and Strahan. So our goal was to use shocks which were up to the standard of the reduced form literature in our structural model. And this paper shows that when there's a natural disaster in a region, that region itself, people tend to say borrow to fix their house after it got hit by a hurricane. But the banks that provide that credit are going to reallocate funds away from the rest of their bank branch network. And this is going to lead to a negative loan supply shock, not where the disaster happened, but in regions that have bank branches of the same banks that are active where the disaster happened. So this reallocation within bank branch networks after a natural disaster gives us this indirect loan supply shock at the rest of the bank branch network. The assumption for validity is disasters in one region do not directly affect loan demand in others. We have to say that the changes which propagate through the network are solely through the supply side. That's the assumption of the instrument, which we think is relatively credible. So we're going to estimate a logit demand system, which is the simplest sort of IO style demand system you can estimate. It has the nice property that if we look at the log difference in two banks' quantities in a market, that is going to be linear in the interest rates they charge and whatever observable and unobservable characteristics are left over. We don't want to run OLS to estimate this because the unobservable characteristics might be correlated with the interest rate. If you've got a great bank branch network, people might desire to invest there, and that might be reflected in the optimal price you choose. So we're going to estimate this by two-stage least squares using this reallocation after disaster instrument I just told you about. And because this is in differences, we have to put market level fixed effects to identify this parameter alpha, which is how much your desirability of a bank is affected by a change in its interest rate. So here's our results. And the top row here is the interpretable things. These have the interpretation that a 10 basis point increase in deposit rates at an individual bank branch gives it about 4.6% more deposit quantity, but a little bit over 50% drop in mortgage or loan quantity. So for an individual bank branch, the deposit market is considerably less elastic than either the mortgage market or the loan market. But this is identified only looking at cross-sectional differences between two banks. We're also interested in the aggregate elasticity. If everybody changes their interest rate, that would difference out here. And we need to know how the whole market responds by an aggregate interest rate change if we're interested in macro type counterfactuals. So the last thing we're going to do, and this is new econometrics, which I don't have time to get into here, is there's a way in these logit models where you can construct a single measure of how desirable it is to borrow at the composite good of like any bank branch in the market. And then we can take our instrument, aggregate it also up to a measure of how much disaster damage propagated through everybody's bank branch networks to become a loan supply shock here. And we can regress this market level quantity on an instrumented market level shock to loan supply to estimate the aggregate elasticity of demand. And our interpretation of the results here, these parameters say that when an individual bank changes its deposit rate, 29% of the new business it either gains or loses is coming from outside of the market rather than being reallocated from the rest of the existing branches. But for mortgages, it's only 8%. So the mortgage was very elastic for the individual bank, but at an aggregate level, not so much. For corporate loans, we observe an outside option here. We see the firms that do not borrow at all, and following standard IO approaches, this gives you, given the size of that, roughly a 40% for the number here. So the loan demand system at the aggregate level that we're interested in is by far the most elastic. That's why we find that the loan quantities are the most responsive to QE. All right, so that's the demand side of the model. To summarize, we estimated these demand systems first at the micro level, comparing the difference in two bank branches. Then we did it at the aggregate level with market level shocks. And we found that the loan demand system for syndicated loans and deal scan is much more rate elastic at the aggregate level than mortgages or deposits. And that's why that's the area where we see the big quantity response. The last step is to figure out if we inject all these reserves into the banking system, what happens to banks' cost of capital? And that's where we're going to have to estimate the supply side of that cost function that quantifies how a bank's marginal cost of providing deposits or loans is impacted by its reserve holding quantities or the other quantities on its balance sheet. That's what we have to estimate next. So this is the side where we're going to throw demand shocks at the supply side of the model and see how we can trace out that supply, or in this sense, marginal cost curve. So we set marginal cost equal to marginal revenue, as we always have. That's the first order condition that in the model the banks choose. We've estimated the demand side of the model so we can observe the marginal revenue now effectively. That gives us realized data points of each bank's marginal cost. So we now know it costs, say, 40 basis points to provide deposits in a given market. What we don't know is how that is changed by an exogenous shock to the composition of the bank's balance sheet. Because we have multiple endogenous variables here, we're going to need to use multiple instruments to identify this. So this data on these realized marginal costs we've generated using our model, we're going to see how that responds to exogenous shocks to the composition of the bank's balance sheet to identify this remaining function C. So the way we're going to do this is the classic idea with a one-dimensional model is you shock demand, it traces out the supply curve. Because multiple goods are supplied jointly, we're going to see how moving all the quantities on the bank's balance sheet jointly, when you shock them with an instrument, change the bank's marginal cost of, in this example, providing deposits. So we're going to use our disaster shock, but not in the indirect way of reallocating across branches. We're just going to say this bank got hit by a lot of natural disasters that raised its loan demand. And then we're going to also use a Bardic type instrument for deposit demand. So if the bank is in a region that has a lot of deposit quantity growth at an aggregate level, that probably is not driven by the bank. That's probably the local economy, and that's going to be a shock to the demand for that bank's deposits. So for both of these two instruments, we're going to regress all of the 4 bank level quantities on the instrument shock, as well as the bank's marginal cost here of providing deposits. And the interpretation of it is these 4 shocks to the quantities jointly, measured by these gamma parameters, cause this change in marginal costs caused by the kappa parameter. What we don't know, though, is whether it was the change in deposits or the change in mortgages and so on individually, which one specifically was responsible. We just get a linear equation that jointly these four quantity changes cause this marginal cost change from our instrument. We're going to do this for both instruments. That'll give us a system of equations. And the details are in the paper. For a 30-minute talk, I can't get into this, but we write down a cost function then, and we pick its parameters to match all of these IV regression results so that we're consistent with the microdata, and we end up with the following cost function. So this matrix here, this is how a bank's quantities of deposits, mortgages, loans to firms, and liquid securities affect its marginal cost in the markets in which it's active. So this has the interpretation, just to give you a sense of the numbers. Let's put 1 trillion of reserves into the banking system and divide it equally across all the bank branches that exist. We normalize everything by branch in our specification. That's going to be 184 million per branch based on the data in 2007. And we multiply that by the parameters at the bottom of this matrix, the bottom row. That's how much reserve supply quantities affect the various marginal costs. The 0.0203 multiplication gives you a 3.73 basis point change in the bank's required return on holding reserves. Think of that as a change in the spread between the reserve rate and the Fed funds rate, and leads to a 2.3 basis point change in the opposite direction in the cost of deposits. Another interesting thing is if you look at mortgages and loans, their columns are very similar to each other. So we didn't hard code this into the model, but we get that loans either to households or to firms are relatively similar in terms of how banks consider them as an asset on their balance sheet. And we also get this classic deposit lending synergy, which is at the heart of banking theory, that if you provide more loans, it's cheaper to provide deposits. If you provide more deposits, it's cheaper to provide loans. All right, so once we've estimated all this, this identifies what we need to run a counterfactual of injecting reserves into the system. So what we're going to do now is take a large quantity of reserves. This 4.76 trillion quantity is what we're going to inject in our benchmark. We do some stuff more calibrated to quantities over time in the paper. And we pick that number because that's enough to raise the required return on reserves by 15 basis points. Roughly speaking, that is this 3.73 per trillion scaled up to reach 15. It's a little more complicated because we re-clear all of our markets, but that tells you the benchmark size. So we're going to inject that amount of reserves. That's going to give us a 15 basis point spread between the reserve rate and the Fed funds rate, as we roughly see in the data. And we're going to let banks re-optimize all of the interest rates they pay and charge for lending and deposit making, as well as trade reserves with each other in a competitive market and clear it at a new equilibrium. So this is relatively high dimensional. Happy to talk about the methods offline if you're interested. But the benchmark we're going to find is that 15 basis point in change in the reserve rates passes through to 6 basis points, 5 basis points, 4 basis points for deposit, loan, and mortgage rates on average. But because the loan demand system was so much more rate elastic than everything else, we get about a $550 billion dollar reduction in loan quantities to firms in our syndicated loan data, a little increase in deposit quantities, a tiny decrease in mortgage quantities. So similar rate pass-through, but large quantity difference in terms of 550 billion of loan supply reduction and not much elsewhere. So to summarize, this is this reserve supply channel of QE that we're studying in this paper. There's also effects of QE on, say, the term structure of interest rates, mortgage refinancing because of rate drops and so on. We don't want to say that that's not also part of the transmission mechanism, but our model, which has been designed to study the assets side of bank balance sheets specifically, is designed specifically for this reserve supply channel where we injected trillions of reserves into the banking system and calculated a new equilibrium. We estimated the model using these cross-sectional instruments to have the supply and demand framework. We quantified these cost synergies, which told us how holding reserves affect deposit and loan cost of capital. And we came to this finding that every dollar of reserves crowds out 13 cents of lending to firms, leading to about 550 billion reduction in bank loans to firms when you aggregate it up to the size we look at. If you think that this is an unintended consequence, this is negative. You might want lending to firms as well as QE. You could change QE in a couple ways. Relaxing bank leverage regulation, the supplementary leverage ratio would loosen some of the regulatory constraints that we think make it costly to hold reserves. It might also be possible through either reverse repo facilities or central bank digital currencies to allow assets like reserves to flood out of the banking system so that they're not constrained to be held by a specific actor. And these might be some potential changes to make QE still potent in the ways others have studied, but that the channel we're studying, this unintended consequence of reducing lending, could be reduced. Thanks everyone for listening, and we have a few minutes if you have any questions.
Yeah, thanks. Can I ask a question?
Sure.
Yeah, no, this is fascinating. I was wondering if you guys have thought. I understand that this is very hard to do, but if you have thought about the fact that there might be potential substitution from like traditional lending, which is like kind of what you're measuring with Dilscan, well, syndicated lending, but what's called traditional lending.
Yeah.
And just like more indirect lending, as in like banks just like switch from like direct lending to just like holding bonds and securities issued by firms.
Yeah. I think for the substitution the banks are doing here is to holding reserves in the first place. So I think the substitution would be more that non-banks would be lending to firms would be the direction, because we're already filling up the bank balance sheet with all these assets as the side effect of QE, where it's the other people who might have sold treasuries that get bought in QE. They're looking for something to hold. And this might motivate a few different things, either bank firms substituting towards the bond market. Potentially, we could look at that in the data. We haven't gotten into that. This might motivate something like the rise of CLOs. This is sort of a structure for non-bank investors to enter.
Yeah, that's where
market.
I was heading. Yeah, with my question.
Yeah. So we don't have any clean identification on which of these channels would be the natural way to substitute. But given that the CLO market boomed in a correlative sense at the same time QE was happening, it's consistent with our results, at least, that this might have been one of the motivating factors. Any more questions? Looks like we have 1 minute.
Well, I guess we can. Sorry.
Move on. Sounds good.
Okay.
Thanks, everyone.
Yeah. Thank you. Thanks a lot. Okay, so let's move on to Rustam. If you don't mind sharing your screen.
I'm doing that now.
Yep.
All good.
Looks good. Yeah. So why don't you just take it away?
Okay. Thank you, everybody. Thank you, Miguel, for organizing such a great team of like-minded people. So today I will be presenting something that used to be my job market paper, now just a paper, a macroeconomic model with heterogeneous banks. And the basic theme of this work is very simple. The idea is to study the intersection of the macroeconomy and the banking sector in a way that is consistent with the microdata. When I say study, I mean looking at positive, normative, and policy implications. And when I say micro-consistent, I mean having aggregate implications that are in line with the distribution of banks that we observe at the micro level. So the purpose of this talk would be to convince you that having environment, having frameworks with bank heterogeneity is essential for essentially any kind of policy relevant question that we might ask. But the ones that I will be pushing more a little bit today are three facets: efficiency, competition, and stability. Each by itself, I guess we can all agree, are something that we really want to study by itself when it comes to the financial sector. So we want the banks to be efficient. We want to monitor competition, and we want to prevent financial crisis. So we want to maintain financial stability. So it turns out when you put these three factors into an environment with a realistic bank size distribution, then it turns out that these three factors are mutually incompatible. So you have a trilemma for bank regulation. So again, if efficiency, competition, and stability cannot improve in response to no single policy instrument that you can that the regulator, being the fiscal authority or the central bank, could implement. So this is a quantitative theory, but I will be trying to prove this theorem in a quantitative way with some microdata as a backup. So just to lay down some microdata for us to have a picture of what I'm trying to do here. So 4 facts for you. Fact 1, the banking sector is very concentrated. That's fairly obvious, or at least for us who studied the topic. So up to 65–70% of the assets are concentrated in the top 10 largest institutions. So that doesn't necessarily mean anything bad per se. It could be an efficient outcome, but it's a symptom potentially of some market structure issues that we should study. So when you actually take the next step and say, okay, so is it true that concentration in banking is a symptom of low competition? And you take existing state-of-the-art approaches and you measure markups for banks, you find that markups are A, high, and B, they correlate with size. So that's the first argument for having an environment with size heterogeneity, is that if you want to study imperfect competition, then the competition framework has to be related to the size distribution. So in this particular context, markups will be increasing with size. And by size, I mean assets or net worth of the intermediary. Second, there is a large empirical literature in banking that claims that there are economies of scale. So what I'm plotting here is that the leverage growth of banks positively correlated with total asset growth, but you could find a less pretty picture, such as marginal costs fall with the size of the intermediary, and there are many other statistics that one can track. But a lot of independent studies have pointed that intermediation efficiency is something that is concentrated in the right tail. So again, if we want to study efficiency, we need to have some notion of size pinned down and some degree of concentration in order to analyze anything quantitatively that's reasonable. And finally, I mean, financial stability, if there is anything that we have learned over the past 20 years, that's the first order issue. But it turns out, and it's not surprising at all, that if instability is concentrated in the left tail of the distribution, and here I'm only focusing on insolvency risk or exit risk. So for now, I'm not making any too big to fail claims. I will return to them later. So merely from the point of view of exit risk, being be that forced exit or being acquired in an aggressive way by a large institution, those risks are all concentrated in the left tail. So again, something a factor that is very strongly and in fact monotonically related to size of the banks. So yeah, so you're motivated with these 4 facts. I will be developing a framework and discussing it with you in a moment. The model will be able to replicate these facts, and we can study some interesting policy counterfactuals. So very quickly, a related literature. So there is an explosion in the past few years of important papers on heterogeneous intermediaries. In terms of imperfect competition in banking, there are 2, maybe more, but I see 2 branches on credit market power and deposit market power. So, but my focus today is on the market power on the asset side of bank balance sheets, but there is a very important complementary channel as well. The deposit franchise is a source of market power for banks as well. And there is also some growing empirical literature that is providing evidence for existence of what I call uninsured idiosyncratic credit risk, or essentially Bewley, Aigari, Huguet, Imrohoglu type of frameworks for financial intermediaries. That immediately implies the presence of some kind of precautionary lending motive, and we can bring all the tools of those heterogeneous agents models and by extension the Hank literature to the case of financial frictions. And when we put those two together, beautiful things can happen. So let me dive in straight to the model. So yeah, should be on time. So the meat of the model is the capital goods producer. So the first major departure from a standard setup is the way capital will be aggregated in the economy. So there are continuums of you can call them financial varieties J. So J is an index of heterogeneity that will be that has multiple interpretations. My favorite one is geographical. So you could think of local markets, and there is one bank serving all markets. You could think of J as having a product-based interpretation. There are fixed income derivatives, equity, exotic equity derivatives, and all kinds of financial varieties, and the borrowers require all of them in order to construct the capital stock. Or J could have the bank level interpretation. At literally there are 5,000 banks in the US. They're all competing with each other, but customers potentially have, in Kyle's and Miguel's word, they have preferences for particular banks. So banks enjoy some kind of customer capital base. So the aggregator is non-CES. So not only am I departing from the efficient aggregation benchmark, I'm also imposing that markups are potentially size dependent. So there will not be a constant markup which will be invariant across time and across the cross section. So the Kimball aggregator is amazing at that. It will deliver essentially all the cross-sectional properties that we want. Subject to the Kimball aggregator, the capital goods firm solves the usual problem, and we find a familiar to all of us demand function for bank funds. So the implicit assumption here is that the firm wants to produce, but it lacks funding, so it has to borrow from banks in terms of claims on the future capital stock, because of the aggregation technology, banks will be able to extract markups from firms. So far I haven't specified this capital gamma function yet. So it's a very general. So now let me specify, take a stance on the formulation, and I follow what is by now state of the art is the Clino-Willis specification. To spare you some of the technical steps that is needed to derive the markup function, this is how it will look like. This mu as a function of y, where y is the relative size of the bank. So the markup will depend on the relative size of the bank in a way that makes markups increase with relative size. So remember, that's our fact 2. Competition in the banking sector is low, and also markups increase with size. So the aggregator will give us that property as long as the superelasticity is positive. And the superelasticity here is epsilon over theta. So another cool thing about this approach is that the CES case is nested for epsilon equal to 0. So immediately that shuts down the idea that as the relative size goes up, the elasticity falls. That we kill the channel, and the elasticity is the same for all agents. Okay, so we can nest the perfect competition case. Okay, so now to the bank's side of the problem. So the first equation is the standard balance sheet constraint. So on the right-hand side, we have their assets. They invest into claims on capital that will be produced by the capital goods producers. They accumulate net worth. They can borrow from households, and the deposits will be priced competitively together with households. I will describe how. On the asset side of the balance sheet, the banks receive two types of returns. So their total portfolio return is a weighted average of the systematic return on the neoclassical capital stock and the idiosyncratic component Xi-J. So Xi-J is the uninsurable idiosyncratic rate of return risk, which is has the J bracket, meaning that each bank or each local market or each product receives its own J-specific return draw every period. And as long as we have a little bit of persistence, a distribution of bank size will emerge in equilibrium. So there is a reason, there is a historical reason why this process is run. In fact, in a parallel paper using Norwegian data, we have estimated that process, exactly that process for the Norwegian bank firm administrative data. So there is no reason for this particular formulation, except for that we have some idea of what rho and sigma are, correlation and volatility are. But in principle, it could be your favorite specification. So in the spirit of Gertler, Kiyotaki, and Gertler-Corradi, banks face a leverage constraint, which has a moral hazard intuition. Law of motion of net worth is what you see in the middle here. Next period, bank receive the return on their portfolio investment. They pay off the depositors, and they also pay a non-interest cost. It's going to be important for me that they are non-linear. So non-linearity will break scale variance and pin down the size of the intermediary. If you take away non-interest cost, the model will be linear with respect to net worth, and there will be no notion of size to speak of. Finally, there will be endogenous default. Again, it's only insolvency risk, so I don't have bank runs, for instance. In principle, those could be introduced, but it's not in today's paper. So this is the bank's dynamic problem. So that's their value function. So they maximize the stream of future discounted flows of net worth. They pay off the households in terms of dividends, and the dividend structure is very simple for tractability. So it's a fixed and time invariant fraction of their profits goes to the household, and the remaining fraction is kept in the program. And here the marginal rate of substitution. This is the SDF of the household which the banks borrow and then augment with the dividend payout rule. And the constraints that banks face are the 6 equations which are listed in the previous 2 slides, plus the demand for financial varieties, which comes from the Kimball aggregator. So, and banks internalize the idea that they could exert market power, but of course they don't internalize their impact on aggregate prices. So this is where we will have the aggregate externalities.
So just to clarify, the main deviations from Gertler-Kiyotaki, for example, here would be the non-CES demand, the market power part, and that cost that comes from your size, right?
Yes, so there are 3 deviations, you're right. So the first deviation is because the beauty of Gertler-Kiyotaki world is linearity. So I want to break it. I want to make the model intractable on purpose. So that's why we need these costs. Second, imperfect competition, that's the aggregator. And third, this idiosyncratic return, which is persistent. They also have idiosyncratic shocks, but for them, they are IID. Persistence forces me to track the distribution over time.
Thank you.
Is it important to think of your notion of default here as negative net worth as default? Like how would your sort of trilemma results go through if I were to say you could issue equity your way out of that at some cost? Is that first order or?
Great question. So I don't know. So so they don't have, the banks here don't have the option to issue equity.
Mhm.
Just like they don't, the households equally don't have an option to extract higher dividends from bigger banks. So Sigma could be potentially also just. So yeah. So so I don't know if it's first or second order. I don't like to speculate. I love to do it by brute force to actually solve and see. But yeah, the quick answer is I have no clue. So the remaining parts, in the interest of time, I will skip. So there are some useful but not essential components. So there is entry and exit, similar to Mellett's, but the Mellett's structure is a one-shot entry for me because the model is dynamic. There is entry every period. And again, the way it works, the potential aspiring investment bankers, they draw their the startup realization of their idiosyncratic profitability. They receive some net worth transfer from the household. If they like what they receive, they become a bank. And and the mass of intermediaries HT, which it will grow up. So that slightly complicates the model because now I have to keep track of the mass of entry, but it's fine. So the household problem is fairly standard. And the first order condition of the household problem pins down the deposit interest rate, which is importantly bank specific. So every bank type will have its own risk profile dictated by the history of idiosyncratic draws and the size, the net worth. So there are two idiosyncratic state variables: perfect information, perfect visibility, and households know exactly who they're dealing with, and they price competitively all the risks that they see. An important assumption here is that there is no deposit market power. So there is perfect competition on the deposit side, which potentially is also something that could affect my main results. But it's just the models would just at today's stage it would become be too much for me to handle. But maybe in future work that could be introduced. The final goods producer is very standard. Capital depreciates every period. It doesn't affect the results. It just makes my life simpler because otherwise I would have to artificially create a new price of capital. To achieve a stationary industry equilibrium, all markets must clear. Okay, now to the main result, and I will walk you through results in the following way. So the most important equation that comes out from the model is the decomposition of relative prices on firm claims into markups and marginal costs. So remember, as long as the superelasticity in the Kimball aggregator is positive, we will have one of the four facts that markups increase with size. So we get the endogenous competition channel right, thanks to the flexible aggregation technology and calibrating the sign correctly. Marginal cost, for as long as there is some presence of incomplete markets, as long as the idiosyncratic shock is at least slightly persistent and kappa is positive. I mean, kappa is the weight on idiosyncratic risk in the total portfolio return formula. So this will always give me the second fact that marginal costs fall with size. And here the intuition is a little bit more complicated. As banks accumulate more net worth, they become more efficient because the only reason why they are big is because they have a good history of idiosyncratic draws. So their marginal cost will be low because they have accumulated a lot of net worth, which is an endogenous outcome of their luck. So they are efficient because they have been lucky for a long period of time. And there is also another component that falls into marginal cost. That's the default risk. That's as Kyle correctly corrected me, it's really the exit risk of intermediaries. So it will fall with size, and we get financial stability, right? The intuition here is straightforward. The probability of exit is mechanically linked to the size of the balance sheet. So the smaller net worth gets, the more likely you are that you will draw a negative enough idiosyncratic shock such that you exit next period, and you may or may not be replaced, because remember, entry is endogenous as well. So the main result is really this picture. So by introducing idiosyncratic shocks and having scale invariance, we get a concentrated stationary distribution of bank size as part of the solution concept. So this idea goes back to decades ago. So it's essentially operationalization of the Bewley-Huggett-Agari environment for banks. So as long as you have an insurable idiosyncratic risk, some notion of scale variance, and you get this right skew distribution of agents. So we have some degree of concentration. I don't get concentration completely right, in a sense that it is hard for the model only with idiosyncratic shocks to get the Herfindahl index of the banking sector that we see in the data. To get 65% of assets concentrated in 10 banks, you need more tools, and that's something that I'm working on right now. So on top of this, on top of the core skeleton of the model that just gives me size heterogeneity, now we introduce the Kimball aggregator. We have the imperfect competition idea. So here, overlaid on the histogram are the absolute credit markups. So just like in the empirical motivation before, we see that markups will be increasing in bank size. So that's the endogenous competition channel. So the economies of scale channel can be displayed by simply plotting the model implied relative marginal costs for all banks. So the marginal cost is the object that I showed you on the previous slide, where I decomposed prices into markups and marginal cost. So markups fall with the size of the intermediate, and we already see some interesting potential problems here, because as the banks get larger, they're more efficient, so marginal costs are lower. So potentially we can get a bigger bang for the buck from them. They might have a higher marginal propensity to lend, but higher concentration immediately implies lower competition, as the average markup increases with the right skewness of the distribution. And that's already not a good sign from a policy perspective. And finally, we throw in the endogenous exit, so the financial stability channel. Here, the black square, the probability of default is essentially zero for larger intermediaries. That's not surprising, but it can be quite significant the smaller the bank gets. So now we have the size distribution and the three channels: competition, efficiency, and stability. So this is where the trilemma arises. So it happens to be the case that the same banks that are stable and efficient, they have low probability of default, low black squares. They are very efficient. They have low diamonds. They also have a greater credit market power because their credit demand elasticity is low endogenously. So that means, so whatever, that's a generalization that you have to sort of argue for, but no single reallocative shock can simultaneously improve competition stability and efficiency at the same time. So any policy shock that affects the third moment of the size distribution will impose a change in the allocation of credit in the economy. If you somehow manage to come up with a shock that just shifts everything symmetrically, that the net impact on skewness will be zero, then yes, you might get something. But any taxation scheme, any a monetary policy expansion would not have the zero skewness result. Why? Because marginal propensities to lend, marginal utilities, marginal values of net worth. All of these marginal objects are very heterogeneous across the distribution. So any aggregate shock that you can possibly think of would have to go through the trilemma situation. And on this slide, I'm listing some of the examples that I have actually tried by brute force in studying them in the paper. So you might argue that, well, you might, if the social planner might undo the trilemma, but in fact, it doesn't work. So the social planner actually reinforces it because it will reallocate more assets to bigger banks. They have a higher marginal propensity to lend. In fact, the social planner will lead to a cascade of defaults of smaller intermediaries. It really wants to have few but big and efficient and stable intermediaries. So again, the trilemma holds. You can impose size-dependent capital requirements or deposit insurance schemes or the too big to fail externality. Again, the trilemma holds. And when I say the trilemma holds, I mean that if you calculate the aggregate levels of markups, investment, consumption, and the average probability of default, you will never have all of these objects improve at the same time. So you will have a deterioration in some dimension and you will improve some other dimension, but you will have to make a sacrifice somewhere. And there are other quantitative exercises I do in the paper, which are now in a very lengthy appendix. So I look at the rise of banking concentration, emergence of fintech credit. So a lot of very creative ideas, but it's really it's simply an interaction of three frictions which happen to match the data. So in conclusion, so it's really just a framework to think about interesting stuff in macro banking. It's calibrated and operationalized to match some key cross-sectional patterns. It provides us with a novel trilateral trade-off to think about classing and new policy-relevant issues. So it's also not that difficult to work with. So in progress, we have an extension with monetary policy and nominal rigidities that we very ambitiously called H-Bank. And an important, probably first order limitation of this theory is competitive deposit pricing. That's something that should be worked on.
Thank you very much. We have like a minute for in case anyone has a question.
Yeah, what makes you think that deposit market power would be first order here? Because my intuition is that would point exactly in the same direction that you have, that it's correlated with loan market power. It would just be a different manifestation of the big banks in your model have lower funding costs through lower default risk. It would just be they have higher markups or higher markdowns, I guess.
That's exactly what happens, and that's also true for your framework from if you have say deposit client capital, that would also be correlated with net worth. So in fact, that would only reinforce the results. But it is a thing that people really want to see this aspect.
All right, let's move to the next speaker, Pierre Mabille. Can share. Okay, we can see your screen.
All right,
So,
can you guys see my screen all right?
Yes, we can see you and we can hear you. So you can take it away.
Okay, well, great. So thanks very much for being here. Thanks, Miguel, for including our paper in the program. This is a joint work with Olivier Wang from NYU Stern on intermediary loan pricing, which, as you will see, is an analogy with intermediary-based asset pricing. So the goal of this paper is really to understand how bank loans react to different types of shocks that hit bank balance sheets. You can think of credit supply shocks like a credit expansion or a credit contraction. You can think of demand shocks, borrowers suddenly becoming riskier. You can think of monetary policy shocks acting through banks' cost of funds or through some, for instance, channels that Will described, or any type of risk shocks. So what I want to do here is sort of break down this question into 3 parts, which I will motivate with aggregate and micro data. And then I'll sort of try to write down a model to jointly explain these facts, which we think is the new contribution of the paper. First fact that we want to draw your attention on is the strongly negative correlation between banks' losses, these charge-off rates here for mortgages, for households' mortgages, and loan growth. So in other words, when banks are making losses, they are lending less. So there's a strong negative correlation between, if you will, the health of bank balance sheets and the volume of loans that they are making. The second fact, which we want to draw your attention to, is that this might be happening through different loan terms. If you look at the bottom panel, we've plotted the maximum loan-to-value ratio on these mortgages and the mortgage spread. So what might be happening is that loan volume is just decreasing because spreads are increasing, which makes it less appealing for households to borrow, or this volume might decrease simply because credit constraints, LTV constraints might become tighter. And indeed, if you look at the maximum LTV constraint and the mortgage spread, there's a positive correlation between them. In other words, there is a negative correlation between mortgage spreads, the price terms on mortgages, and the down payment requirements, which are 1 minus the LTV constraint, if you will. So in other words, there seems to be some sort of substitution margin going on between these 2 terms. So for instance, after the great financial crisis, when maximum LTV constraints start being relaxed, at the same time you see the mortgage spread increasing, as if banks wanted to sort of compensate for greater borrowing through the non-price margin by restricting this borrowing through the price margin. And you see the opposite happening before the great financial crisis. Now, this is true for household mortgages. This is also true for households' credit cards. And here in this talk, I'm just going to focus on household data. We have firm data in the paper. For credit cards as well, we do see this strongly negative correlation between banks' losses, this dashed line, and banks' loans and these credit card loans that banks are making. However, here are the dynamics of credit standards, this blue line, which is from the SLOOS, so that's the net percentage of banks tightening standards, and the spread are somewhat different from mortgages, with the spread increase being a lot stickier. Sorry, I can plug my laptop. With this increase in the spread being a lot stickier for credit cards than it was for mortgages, and on the other hand, the increase, the tightening in non-price terms, being a lot more short-lived than it was for mortgages. So this is sort of this second fact. So there's a cross-section. So first, there's a negative correlation between the health of banks' balance sheets, or so if you will, in other words, there's a positive correlation between the health of banks' balance sheets and the volume of loans that they are making. Second, there is a cross-section of loan terms. Not everything is going through a price adjustment. Something is going on through non-price terms. It can be LTV constraints, can be PTI constraints for mortgages. It can be credit standards. If you look at credit cards, if you look at firms, it can be covenants. And that's in the paper. So these are the first 2 facts. Third fact is that these relationships, if you will, are strongly different when you look within a given category of loans. They're strongly different between borrower types. So here what we've done is we've looked at risky households with low FICO scores in red and safe households, if you will, with high FICO scores in blue. What we see is that after the great financial crisis, there's a strong decrease in the typical loan that is made to a risky borrower, while it's more or less unchanged for a safe borrower. It might be puzzling if you just look at price terms on the upper right panel. If you look at loan rates, they have very similar dynamics across these risk categories. So what might explain this is more probably this very strong decrease in the LTV constraint of risky borrowers, while we don't see that for safe borrowers. In other words, these dynamics, the dynamics of these price terms and non-price terms, are very different across risk categories. So that's this fact that we want to document here for mortgages. And the same fact holds for credit cards. So there's there's not a lot of easily publicly available data for credit cards. So what we can do is look at Jonas Strobel and Agarwal et al. QJE paper on credit cards, where they find that for credit expansion now, so for a 1 percentage point reduction in banks' cost of funds, so for this credit expansion, it leads to an increase in the credit limit of risky borrowers of only $253, while on the other hand, it leads to a large increase in the credit limit of safe borrowers. In other words, credit expansions are passed through to safe borrowers who do not need to borrow so much. If you think about it, that's exactly the opposite story of what happened with the mortgage expansion of the 2000s. If you think of the Mian and Sufi paper, where the credit expansion on the mortgage market primarily went to risky borrowers, to these subprime borrowers. So the goal of this paper is to sort of try to make sense of these three facts, to jointly explain them in the simplest framework as possible. So just to recap, what we've seen from aggregate and micro data is that first, there's a cross-section of multiple loan terms. So there are both price, interest rate, and non-price terms like covenants, like LTV, PTI ratios. And there's a cross-section of them, meaning they differ across borrowers with different risk. Second, this cross-section of multiple loan terms responds to shocks to bank balance sheets and to policy. We've seen this strongly positive relationship between banks' health and the volume of loan that goes through these price and non-price margins. And finally, these loan terms respond very heterogeneously across borrowers with different risks. So here, again, what we want to emphasize in this paper is that both price and non-price terms adjust. So what we're going to do is we're going to build a framework which we think of as intermediary loan pricing, in an analogy with intermediary asset pricing, where bank balance sheets affect the terms of the loans that banks are issuing to different types of borrowers on different markets. What we're going to do is think in this framework about the heterogeneous incidence of shocks to banks' balance sheets. So here in this talk, I'm going to focus on credit supply shocks, so an expansion or a contraction in banks' lending capacity, and time permitting on a change in banks' cost of fund through a typical monetary policy shock. We're going to see how they affect differently mortgage and credit card markets, risky versus safe borrowers. And in the paper, we sort of try to speak to the evidence on firm versus household. These two approaches, these 2 points, if you will, have implications for the dynamics of credit crisis. And here we're going to show how very simple elasticities can capture the impact versus the persistence of a shock, and how they affect the entire dynamics of a credit crisis. So what we're going to do in this paper is we're going to try to speak to both the micro and the macro evidence. We're going to add to frameworks like Stiglitz-Weiss at the macroeconomic level, in which there's credit rationing, but interest rates or spreads are fixed. So you have some credit rationing on the quantity side, but you have nothing happening on the price side. And on the other hand, you have Holmstrom-Tirol, where that's the opposite. The spread is endogenous, but there is no credit rationing. So we're going to try to have both credit rationing and endogenous spreads within a model. So in other words, we're going to try to endogenize both these price and non-price terms of credit contract to speak to the rich microeconomic evidence that both these terms are important. On the macro side, we're going to contribute to some of the literature, like many papers that were presented today, for instance, by Kyle or by Will, to this sort of macro asset pricing literature, which focuses on the dynamics of credit crisis and the role of banks' balance sheets for this credit crisis. So without further ado, let me jump into the model. So the goal here is going to be to build a model that's as simple and as general as possible, which potentially connects different quantitative frameworks. Key ingredients of the model are going to be, first, information asymmetries, which are going to generate endogenous default risk. You can think of adverse selection on loan markets. You can think of moral hazard as well. We have simple examples in the paper where we show that our framework nests both. Second, loan contracts are going to be multidimensional, they're going to have both price terms, interest rates, but also non-price terms. So quantity restrictions and potentially non-price, non-quantity restrictions, such as covenant restrictions or documentation restrictions. Third, banks are going to compete for borrowers subject to a capacity constraints on lending. So what's the problem? So again, we want to think of this problem in the most general framework as possible. So borrowers have an expected indirect utility function over a loan contract, so CI for borrower I, with a rate RI, some quantity limits LI, and some non-price terms like covenants ZI to the contract, and they have some expected indirect utility over that contract. On the other side of this trade, you have banks with an expected profit over a contract to borrower I, conditional on take-up. Banks are subject to a lending capacity constraints on their total loans to cross-section of borrowers, which must be less than some lending capacity constraint L bar. You can think of it as regulatory constraints like Basel III kind of restrictions. You can think of that as stemming from deposit market powers. It's hard to attract deposit to fund loans. There can be many explanations for this constraint. We're not taking a stance on what it is. Importantly, the different loans for different borrowers have different weights in these capacity constraints, which will restrict more or less the loans to this borrower class. So you can think of these risk weights, rho I, as risk weights, simply in a Basel type of regulatory constraint. You can also think about them as the ability of the bank to securitize the loans, take them off its balance sheets, and therefore, so that they do not matter so much in the lending capacity constraint. What's the problem? Because banks compete to attract borrowers, that's going to be a Bertrand-Nash equilibrium with capacity constraints. What's the problem of each bank? B. So each bank takes as given borrowers outside options, which we call VI bar, and they try to maximize their expected profits to all borrowers by offering different types of contracts subject to their lending capacity constraint and subject to a participation constraint on borrower's side. For borrower I, we want to give that guy at least their best outside option to attract them. So what's the equilibrium? Well, an equilibrium is for a given bank to associate to a given borrower some contract, CIB, and whether this borrower is being lent to, which is going to be the case in equilibrium. So such that borrowers optimize, that is the outside option of borrowers is really the best option that they can get when they competitively search across banks, if you will. And second, markets clear. In other words, every borrower is getting their loans.
That's a question here.
Yes.
So you have the bank choosing loan terms and a price and offering it. Is this similar to they offer a menu of contracts and
that's
people
correct.
Choose? If things are competitive, correct. Is that equivalent? Or?
That's correct. It's an interpretation of our framework. I'm going to come back to that. Yes. All right. So what are the equilibrium conditions that we want to focus on here? So here we want to focus on a symmetric equilibrium across banks. And the equilibrium is described by two conditions, which are actually quite crucial to understand what's going on between these facts that I've shown you. So the first condition relates to whether borrowers are credit constrained. Why? Remember, V is the indirect utility from borrower I. So if the derivative of V with respect to the loan size is positive, it means that borrowers would want to get more loans to increase their utility. In other words, they are credit constrained. They are credit rationed, if you will. If borrowers were on their loan demand, then they would borrow as much as they want, and this term would be equal to 0. So when borrowers are rationed, in other words, when this term is positive, what happens? Well, it must be the fact that this term is positive as well, which means that that this term is negative, given the sign of this term. The fact that this term is negative means that when banks lend more to some borrowers, they are actually decreasing their profits. Why can it be? Well, it can be because there is default risk. And I'm going to come back to that in more detail on the next slide. In other words, to recap, borrower credit rationing is related to the fact that there is some default risk, which is increasing in the loan size that a given borrower gets. Now, the second equilibrium condition is that banks must equalize expected profits, risk-weighted, across borrowers. Well, if it were not the case, then banks could increase their total profits by lending more to the guys with the higher expected profits. Those can be zero, or those can be positive. When are they positive? When the multiplier nu on the bank lending capacity constraint is positive. So in other words, nu is the profit per risk-weighted dollar. When banks are constrained, banks are making profit on their loans. When banks are not constrained, banks are competing, and Bertrand competition drives their profits down to zero. So opening up this expected profit condition, we can really understand what's going on with this endogenous default probability. So we can write expected profit again, so as what banks are lending to borrowers minus their expected loss, minus their cost of funds, minus some costs, potentially zero. This can be the cost associated with non-price terms if there is more, say, documentation requirements that's costly for the bank. What we can do is rewrite these expected profits by using what we call an effective default probability, mu. What this effective default probability does is it encapsulates the loss given default of the bank, right? So if I was really to break down this expected loss, I could factor this R times L term and make this endogenous default probability appear. This framework nests liquidity, strategic default, which stem from adverse selection or debt overhang. That's in the paper. I'm not going to spend too much time on it. But what's really crucial here is that using this default probability, mu, we can rewrite the first equilibrium condition. Remember the one on credit rationing. We can rewrite it in a way that makes this term appear. What's this term? This term is the elasticity of the repayment probability to the loan, to the loan face value. What does it mean? Well, if I'm a bank and I lend you more, by how much do I increase your default probability? Why would I increase your default probability? Well, if default risk is endogenous, the fact that I lend you more, I make it also more difficult for you to repay a bigger loan size. In other words, what this condition is really telling us is that borrowers are credit constrained. In other words, this tau here is positive whenever there is endogenous default risk. Whenever the elasticity of the repayment probability to the face value of the loan is positive, all right? And so together, these terms are going to define what we call a virtual loan demand. What's the virtual loan demand going to be? It's going to be, as Will was saying, sort of a menu of contract that is going to say, well, if I give you some interest rate or I, how much am I going to lend you? That's going to include the effect of bank's capacity constraint. Again, just to recap, this tau here is going to measure how constrained a borrower is going to be. And here, what's going to be crucial when we come to the effect of shocks is going to be how the loan quantity that's given to borrower when banks are constrained changes in response to shocks. We're going to see that it depends on two elasticities. It's going to depend on two elasticities, which will be sufficient statistics for the response of these loan terms to shocks. The first one is going to be the elasticity of the unconstrained loan demand. Imagine that there are no capacity constraints. By how much does lending react when the interest rate changes? If you are a borrower and I increase the interest rate, by how much is your loan demand going to decrease? The second elasticity is going to be this repayment probability, whereby default is endogenous. So again, here what this slide is really telling us is the reason why there is a cross-section of loan terms and not just interest rates. The reason that there is also non-price terms is that if banks were just lending more to borrowers at a higher interest rates with endogenous default risk, it would also lead to a higher default risk on borrower side, and it would reduce banks' profits. To control that, banks need quantity limits, not just price terms. In other words, the reason why we have non-price terms here, again, is because of endogenous default risk. In the interest of time, I'm going to skip the intuitive construction of the virtual loan demand. The idea is that this loan demand comes from the intersection of the capacity constraint of the bank, which may change because of a shock, a credit supply shock, a monetary policy shock, and the indifference curve of the borrower, and the expected, the zero profit condition of the bank. So this is where this virtual loan demand is coming from. This framework has an important implication, which is that if you look at the second equilibrium condition, which tells you that banks equalized profits across borrowers and that those must be equal to the multiplier on the capacity constraint, we can derive that there is in equilibrium an excess loan premium. What's the excess loan premium? Is the interest rate that banks are charging to borrowers in excess of what is justified by the risk-free rate and by their default risk. In other words, this excess loan premium is the difference between the rate that banks are charging to borrowers and what is justified by this default part here and this risk-free rate part here. What is the excess loan premium equal to? It's equal to the multiplier on the capacity constraint. In other words, if banks are very capacity constrained, the excess loan premium is going to be higher. And it's going to be even higher if borrower I is important in your capacity constraint. That's the first implication of this framework. The second implication, as Will was hinting, is that this framework gives rise to something that can be interpreted as a credit surface. What's a credit surface? Well, it's a menu of contracts that the bank is offering to borrowers with different risks. So here what we do is we sort of specialize the model with a Pareto income risk. So the higher alpha is, the riskier the borrower, with liquidity default, and we look at the menu of contract that arises from solving the bank's problem. What do we get? Well, for riskier borrowers, if these guys want to borrow more, if we want to increase the loan size, they must also pay a higher rate. What's the equilibrium that we get from here? Well, we look at the tangent between borrowers' indifference curves and this menu of contracts that banks are offering. We can look at different risks and we can trace out this contract curve. This contract curve is just telling us, look, we study borrowers with different risks. What are the rates and what are the loan sizes that these guys are going to get? And here, there's a super important implication, which is that interest rates do not fully capture credit conditions. As you see here, as risk increases, so does the interest rate to sort of compensate for the default risk. But at some point, the interest rate stops increasing. Why? Because if I'm the bank and I further increase the interest rate, I'm going to make my borrower more likely to default at some point with endogenous default risk. So what's going to happen is then I'm going to choose a non-price margin. I'm going to impose a quantity limit on my borrower to limit this default probability as my borrower gets riskier. All right. We can do that for non-price terms. I'm not going to do that in the interest of time, but in the 5 minutes or so that remaining time that I have left, I'm going to look at the transmission of shocks within this model. So usually in sort of macrofinance models, we think of credit supply shocks as just shocks, for instance, to a maximum loan to value or maximum payment to income ratios in mortgage contracts. So here what we do is really endogenize the variation in these quantity limits in response to a shock. So what's the shock here? Well, think of it as a negative.
Sorry, Pierre.
Yes.
Can I just ask you a potentially very
Sure.
stupid question?
Yeah.
But in your context, what you call a non-price term, the Z, it's essentially some type of monitoring effort, no? Can I interpret
Yes.
it that way?
You can definitely think of it as a monitoring effort as long as it reduces borrower default risk and it is costly for the bank.
Right, exactly.
Definitely.
Okay. Yeah.
But we also think as this quantity limits L, which we had on the previous slides, as well as non-price terms. So basically in our model, everything that's not interest rate is non-price terms. All right, so what happens here in response to a negative credit supply shock? So what does such a shock do? Well, it increases the excess loan premium by 5%. In other words, the bank lending capacity constraint becomes more binding. The multiplier increases here by 5% in our calibration. So what does it do to the menu of contract, to the credit surface? There's a level shift. In other words, borrowing becomes costlier for everybody. But not just a level shift, there's also a steepening of this menu of contract, which is that for these guys, for the riskiest guys, borrowing becomes extra costlier, if you will. So that's really what's happening. And this is essentially what this proposition is telling us. So to summarize, the response of the loan size of given borrower I to a change in the lending capacity constraint is given by the elasticity of the virtual loan demand. The elasticity of the virtual loan demand depends on the unconstrained loan elasticity and on the elasticity of the repayment probability. Not going to go into much detail here, just state that these two are actually sufficient statistics in our model to understand the response of the credit surface to these credit supply shocks. But what I want to do here is really speak. I want to conclude by speaking to the evidence that I mentioned at the beginning and the extent to which credit expansions differed on mortgage markets and on credit card markets in the 2000s, which we don't really have an explanation for. So think about these markets. So first, think about the mortgage market, which we think of as a less elastic market. If you really go to the data, try to measure these elasticities. What happens in response to a positive credit supply shock? Well, interest rate decreases and loan size increases. That's really what a positive supply shock does. If the market is not so elastic, then the rate is going to decrease more, then the quantity will increase. So the face value at the end of the day will decrease. This means that the default risk will decrease because these guys are responsible for a lower loan size. And it's going to decrease even more for risky borrowers who are very sensitive to a change in the face value of their debt. Because banks equalize expected profits across borrowers and default risk decreases more for risky borrowers, they're going to lend more to the risky borrowers in response to this positive credit supply shock, which is the subprime story. Now, if we think about credit cards and the Agarwal et al. QJE evidence, let's revisit this channel. Positive credit supply shock, interest rate decreases, size increases. However, the size increases more than the interest rate decreases because it's a more elastic market. So the face value of the debt increases. It means that default risk increases, but it increases by less for safe borrowers who are not super sensitive to these changes. And then because banks, again, equalize profits across borrowers, it must mean that the loan volume increases more for safe borrowers. So the credit expansion is passed more to these safe borrowers. In terms of policy implications, it's important because it's really telling us on elastic markets, credit expansions are not so much passed through to borrowers who need to borrow, these risky borrowers, but rather to the safe guys with very high credit limits who do not need to borrow so much. I think I'm out of time, so let me wrap up and conclude here. So what we do here is really to come up with this, try to come up with this framework, which we think of as intermediary loan pricing, where banks' balance sheets affect both the price and non-price terms of loan. What's key here is that credit risk is endogenous due to microfrictions, and that's really what differentiates our framework from the intermediary-based asset pricing, which speaks more to the dynamics of equity markets. We show in the paper that, and here I've tried to give the intuition of it, that sufficient statistics, the elasticity of the loan demand and the elasticity of the repayment probability to the debt face value drive the incidence of credit supply shocks, monetary shocks, and when you connect these successive periods, they also have an impact on credit crisis through impact and persistence. Thanks very much.
Thank you, Pierre. We're out of time for the session, so I'd like to thank all the presenters in this session and also all participants who came here in spite of some heavy competition. I hope they learned as much as I did. And yeah, thanks again to everyone, and I hope you have a great summer. And enjoy the rest of the conference.
Thanks all.
Thank you, everyone. Bye.
Thank you.